This chapter 1 describes the basic features of a very simple convertible bond and outlines a process for valuing this instrument as the sum of a regular bond and an equity option. The chapter also analyzes the sensitivity of a convertible to changes in the underlying market factors that determine its value. You will advance more rapidly in this chapter if you have completed satisfactorily our somewhat simpler module on equity-linked notes. Our discussion begins by considering an issuer whose credit spread is 200 basis points over the risk-free rate for all maturities when the risk-free yield curve, taken here to mean the interest rate swap curve, is flat at 5% annually compounded. The issuer's common stock is trading at $40 spot, pays a dividend yield of 2%, and has an annualized volatility of 30%. Note carefully that it is the dividend yield that is assumed to be 2%, which means $0.8 annually when the spot price is 40, but would mean $1 annually when the spot price reaches 50, and so on. This will be an important point to remember in a moment. The issuer recognizes that he could issue a bond for any maturity at a yield of 7%, given the above, but wonders what savings he might achieve if he issued instead a bond that grants the holder an option to convert the bond into a fixed number of common shares under specified circumstances. You propose the following term sheet. Issuer, company ABC, face value 100, issue price 100, nothing very strange so far, tenor 5 years, as agreed, status senior unsecured, but more on that later, coupon 3% paid annually, and conversion option, very importantly, on the maturity date, the holder of the bond may elect to receive 2 shares of common stock instead of the bond's face value in cash. Finally, prepayment. The bond may not be prepaid at any time. You should, without too much difficulty, understand the trade-off implied by this instrument. Instead of the normal coupon of 7% that company ABC pays on its ordinary senior unsecured debt, often referred to as straight debt, the investor here is invited to sacrifice 4% of coupons in exchange for additional and potentially unlimited gains if ABC common shares rise significantly, since the investor could then exercise his right to convert the instrument into 2 shares of common stock. An increase in the stock price by more than $10 over the next 5 years would result in an increase in the investor's IRR above the 3% coupon rate, and a large enough increase would cause this IRR to even exceed the normal return of 7% on straight debt, and potentially by a significant margin. Worksheet basic pricing contains in column C the bond's terms and relevant market conditions. Note, among others, the continuously compounded equivalent risk-free rate of 488, which is used, you may recall, in pricing options under a Black-Scholes approach. This cell here, E17, uses the PV operator in Excel to determine the value, specifically 8360, of a 5-year bond with a 3% coupon paid annually and bearing the senior unsecured credit risk of company ABC. Of course, the investor is getting something else of value, specifically the right to convert $100 in cash at maturity into 2 shares of common stock. You should have little difficulty recognizing that this right is essentially like a 5-year European-style call option on 2 ABC shares with a strike of $50, one such call being worth, according to cell H6, $8.47. The final step is to aggregate these 2 items that we just mentioned to derive a total value for the convertible, here in cell E19, equal to 100.55. Rounding accounts for the 1-cent discrepancy. The diagram now appearing in front of you summarizes this decomposition of our convertible instrument and should require no explanation. Note carefully, of course, the plus sign that appears between the 2 bubbles on the right. Assuming the issue price of this convertible is 100, the investment appears to offer the investor a slightly greater value than its price. This is typically how new issue convertible bonds are in fact priced in the primary market, i.e., with a small value inducement above issue price to entice the investor into the deal, given the limited universe of buyers that might consider purchasing an instrument of this complexity and relatively low liquidity. But one other subtlety suggests that we have slightly overvalued the convertible: the so-called self-referential nature of the call option. Specifically, and in contrast to an exchange-traded or OTC option on company ABC shares, the call option embedded in the convertible bond is a call on ABC shares written by ABC itself. Whereas in the OTC market or on an exchange, a call on ABC shares would normally be written by an independent third party, of course. This is significant because in the present self-referential case, exercise of the call at maturity is, by definition, dilutive to ABC's existing shareholders, since the company would be receiving 100, i.e. through the ability to avoid repaying the debt in cash and therefore conserving its cash balance, but would be issuing shares worth more. This increase in outstanding shares hurts the existing shareholders to a greater degree than they are benefited by the cancellation of the outstanding debt at maturity without payment in cash. In short, we need to adjust downward the fair value of the embedded 5-year call option to reflect this dilution effect. The well-known formula for this adjustment, which we will prove shortly, reads as follows: C star equals C times, and you should read the rest of this formula as n over n plus m as one unit, where C star is the fair value of the embedded call, C is the value of a regular call as calculated earlier on our worksheet, i.e. ignoring this dilution question. N is the total outstanding number of ABC common shares prior to the conversion, and M is the total number of ABC common shares that will be issued assuming conversion, the additional shares. To illustrate, let us assume that ABC has 100 shares outstanding, apart from the 2 shares underlying the convertible. This would lead to C star equals 847 and then times 100 over 102, which makes it 830. This adjustment brings down the convertible's total fair value to 100.20, as you can see here, and the instrument's more accurate decomposition has now been fully restated as shown on this new breakdown diagram. The next 5 minutes or so are spent deriving the dilution adjustment formula we used a moment ago. Skip this section if you do not need to know this. We suppose first that company ABC has N shares outstanding whose spot price per share is S. Therefore, the aggregate market value of ABC is N times S. Suppose also that M call options with strike X are written on ABC stock, but by an unrelated third party, and that the Black-Scholes model reveals these to be worth C dollars each. Presumably, the existence of these calls does not affect the aggregate market value of company ABC, since they involve a contractual agreement between 2 parties unrelated to ABC, and since upon the issuance and or the exercise of these calls, the balance sheet, capital structure, earnings, and cash flows of ABC all remain unchanged. Now change one fact so that these M call options with strike X are issued by ABC Company itself. Upon exercise of these calls, the aggregate market value of ABC would presumably rise by the amount of cash it receives, which is MX, to a total of NS plus MX. But since ABC would now have N plus M outstanding shares, the price of each share should become NS plus MX divided by the sum N plus M. Next, we recall that the payoff at expiration of any call option with strike X can be written generally in this form: max, higher of, 0, final price minus strike. And so in our particular case, the payoff at maturity can be written as, here we go, which is equal to max 0 and the final price, which we just established, minus X. We now give a common denominator of N plus M to both parts of the term in the right, of the bracket, and we cancel as much as we can, leading us to this expression here where the n over n plus m, being not dependent on the price of the stock, can be taken outside the bracket, leaving us with n over n plus m times what is exactly the payoff, but under a normal third-party call. So the payoff under this self-referential call is slightly smaller than the payoff under a third-party call by an amount equal to n over n plus m. The probability, however, of expiring in the money would be the same for both calls, since this probability would not be affected by whether the issuer of the call is company ABC or an unrelated third party. And so we finally have reached C star equals C times n over n plus m. Our most basic pricing model for a convertible bond decomposes this instrument into two components: a low coupon straight bond carrying the credit risk of the issuer, of course, plus a European style call option on the issuer's shares expiring on the maturity date of the underlying bond. From this point on, we will describe this structure as a regular convertible to distinguish it from alternative structures reviewed in later chapters. Now, the self-referential nature of the call option in the regular convertible has been handled elegantly through the dilution adjustment that we were just discussing, but unfortunately a number of other difficulties remain and are not so simple to address. We outline these next. Number one, the bond may or may not rank pari passu with senior unsecured debt. Often, especially in the US, convertibles are issued as subordinated instruments, so that the cash flows under a convertible would need to be discounted by reflecting not the issuer's senior unsecured credit spread, but some higher spread appropriate to that level of subordination for the particular instrument. At the same time, for many issuers, the only credit curve that has any liquidity and transparency is usually the senior unsecured curve, often based on the CDS or credit default swap curve. So some sort of model-based upward adjustment of the senior spreads may be required. Difficulty number two, determining the appropriate stock price volatility to input into the option pricing model is not as simple as that. Most convertibles have maturities between 5 and 20 years, while the volatility implied by traded, OTC, or exchange-listed option prices is based on instruments with a far shorter tenor. It is true that for some stocks, observed historical prices may be available for several decades, but these are backward-looking as a basis for calculating volatility, and therefore not likely to reflect market and company-specific realities today. Difficulty number three, the option to convert the bond into shares is very rarely a simple European option. More typically, the right to convert may arise on designated dates in the future, such as on coupon payment dates, in which instance we would describe the option as Bermudan style, or it may be exercisable on any date in the future, hence American style, sometimes only after the passage of a number of years. Or in more complex but reasonably common instances, it is exercisable upon the occurrence of designated conditions, which makes the option a kind of knock-in option. Any of these alternatives would introduce additional complexity into the pricing process and would push the discussion well beyond the scope of this module. Difficulty number 4. Care should be taken in the calculation of the implied strike price of the embedded calls, particularly where the option to convert is Bermudan or especially American style. For one thing, it is not unusual for the bond contract to specify that accrued interest is foregone when the holder decides to exercise the option to convert. Any such foregone accrued interest would need to be modeled as an increase in the strike price of the embedded call option, and this increase would vary depending on the date of exercise within an interest period, assuming this is allowed. By the same token, some exotic convertibles have conversion prices that reset over time depending on the path of the common stock and certain other market factors. Difficulty number 5. If the conversion option can be exercised prior to the bond's maturity, it becomes harder to determine the value of the bond at that point in time, since this would depend on the level of interest rates, the credit spread of the issuer at that time, and the then remaining tenor of the bond. Much of this would need to be modeled by use of advanced simulation techniques. Difficulty number 6. To the extent the bond and the underlying shares are denominated in different currencies, for example, a Swiss company listed only in Switzerland and therefore having shares that are traded only in Swiss franc, but issuing a US dollar bond that may be converted into its own common shares, further complications arise with regard to the valuation of the embedded calls, turning these into what we would refer to as quanto options, since their strike is in a currency other than the currency of the underlying shares. Quanto options are discussed in our advanced modules on exotic options. Difficulty number 7. Most convertibles in real life are usually subject to an option enabling the issuer to prepay the debt at par or thereabouts prior to its maturity, subject to defined conditions. In and of itself, a prepayment option on any bond reduces its value from the investor's perspective, a matter we discuss extensively in our modules on callable bonds. In the specific case of a convertible, the presence of this prepayment option also has an impact on the value of the embedded equity option, since its exercise by the issuer in effect shortens the tenor of the equity option. Many prepayment options contained in convertibles are normally exercisable by the issuer only once the common stock trades at a predetermined price premium above the conversion price, and are really designed to, as we say, force conversion, essentially by threatening bondholders with repayment at par only, unless they go ahead at that point and convert into the common shares with a greater value. Difficulty number 8, our final point. As if all the above considerations were not complex enough, correlation considerations may complicate further our pricing analysis in a number of ways. Thus, a substantial increase in equity volatility would, of course, drive upward the value of the embedded equity option, and therefore would benefit the bondholder, but would also very often be accompanied, presumably, by an increase in the issuer's credit spread, in further reflection of the perception of rising market uncertainty. Indeed, convertibles are sometimes marketed on the basis that these two factors naturally offset one another, so in a sense they present a hedge of one another from the bondholder's perspective. The sensitivities of our simplified convertible bond to changes in the applicable market factors are relatively straightforward in most cases and are discussed next. The table now appearing in front of you sets forth the reaction of each component of the convertible to an increase or decrease in one of the relevant market factors. In most cases, these changes run parallel to ones we discussed in detail in the module on equity-linked notes, so are reviewed quickly here. As with all such analysis, we assume only one factor changes at a time. The first 6 rows in this table are easy and need not detail us for long. An increase in the stock price, appearing in the very first row, has no impact on the pure bond, but increases the value of the call option, and vice versa, of course, for a drop in the stock price. Similarly, for an increase or decrease in the stock's implied volatility. With regard to an increase or decrease in the stock's dividend yield, you should remember first that the stock's forward price diminishes if the dividend yield increases, and increases if the yield diminishes, given the formula here linking the forward to the spot and to the dividend yield, as well as to the risk-free rate, of course. Therefore, an increase in the dividend yield, since it reduces the forward price of the stock, also reduces the value of the call option, while having no impact on the value of the pure bond. And a reduction in dividend yield, since it increases the forward price of the stock, also increases the value of the call option, while similarly having no impact on the value of the pure bond. With regard to changes in the credit spread, the impact should be reasonably straightforward. Obviously, a widening of credit spreads hurts the value of the pure bond and leaves the value of the call option essentially unchanged. The 2 asterisks after the entries not relevant and are in these 2 cells here make the point that while in theory or in principle a deterioration in the credit quality of the issuer might be thought to reduce the value of an option written by that same issuer, and vice versa in the case of an improvement in credit quality. These effects are very small indeed in most cases, indeed are arguably nil in the case of derivatives the issuer may settle in his own stock rather than by having to deliver cash. We would argue, therefore, that it would be silly to reduce the estimated value of the equity call option solely on account of a widening of the issuer's credit spread, since the instrument does not provide for any future cash flows to be made by the issuer, but rather for merely the delivery of stock certificates to the holder, something it would be difficult to imagine the issuer being unable to do, especially if the conversion option has expired in the money and therefore the company is presumably doing okay. The most interesting rows are the last three, since these are factors that cause each component of the convertible to change in value but in opposite directions. Increases in interest rates clearly hurt the pure bond given the fixed rate coupon, while increasing the value of the call option since they drive higher the forward price of the common stock, as we saw a minute ago. These two effects, therefore, offset each other to some degree or other, and therefore the aggregate impact cannot be determined a priori in all cases, hence the question mark in the last column. Similarly for the passage of time. As time passes, the call option generally diminishes in value, a familiar effect known as time decay, while the pure bond, which was valued initially at 83.6, you might recall, gradually pulls towards par over its 5-year life. And again, it is therefore not possible to determine a priori the aggregate impact in all cases. The last two effects we discussed are repeated on this slide for those who prefer words to symbols, and we pause for a second to let you absorb these somewhat sophisticated concepts. One of the quiz questions will challenge you to determine the specific impact of these two factors given a stated set of market and contractual inputs. We take a moment now to define a number of terms which are often used by convertibles practitioners, and we illustrate each of these by reference to our original convertible bond as per the earlier term sheet. First, conversion price. This is the nominal price per share at which conversion takes place, so $50 in our earlier example. You can think of this as the strike of the call option. Second, conversion ratio. This is the number of shares each convertible bond converts into and is usually expressed on a per 100 units of currency basis. So in our earlier example, 2 shares. Third, parity or conversion or intrinsic value. This is the spot price of the common stock multiplied by the conversion ratio, i.e. it is the value of the shares obtained via conversion at the current spot price, so $80 in our example as of the issue date. Note that a convertible whose conversion option can be exercised immediately cannot trade below intrinsic value. Next, conversion premium. This is the excess of the market value of the convertible bond over its parity value, whether at inception or at any time thereafter. Thus, in our earlier example, the conversion premium at inception is $20 per bond of 100 face value, and is usually expressed, in the primary market at least, as 25%, which we can think of as the minimum percentage increase in the stock price needed until the shares obtained from conversion would exceed in value the bond's initial price, if you like. Last, the cash payback period, a somewhat outdated expression due to changes in the way we analyze convertibles, but this means the number of years it takes until the conversion premium, as we previously defined it, on day one has been recovered through the excess of the convertible's coupon over the stock's dividend yield. So in our earlier example, where a $100 investment in the convertible earns an annual coupon of $3 versus only $2 in dividends with common stock, and given that the conversion premium is $20, the cash payback period would be 20 years. We conclude this chapter 1 with the inevitable and very classical graph, much loved by textbook writers, of the convertible's value plotted against movements in the underlying stock price up and down. To do this, we first turn to this worksheet spot graph, or graph spot. First, you see in column G of this worksheet the spot price of the stock in a range starting at 20, and if you work your way down as we're doing here, going all the way up to a stock price of 90, i.e. representing cases in which the call option goes from being deep out of the money to being kind of at the money, somewhere around here, and then to being in the money, and then to being very deep in the money as we get to prices of mid-80s and 90s. The value of the call option, as you saw, is listed precisely in this column J. And by now you've noticed that we've hidden some columns to fit as much as we can into the screen. Then in column K, we show the value of the pure bond, which of course is not dependent on the spot price of the stock. And finally in column L, the value of the aggregate package, i.e. of the convertible, being nothing more than the sum of the preceding columns on the left. Lastly, in column M, the value of 2 shares of common stock, which of course is what the investment becomes if conversion is exercised. Now, when the call is deep out of the money, its value not surprisingly approaches 0. So the convertible is essentially a simple bond bearing a below market coupon, and therefore trades at a substantial discount from par. Of course, the convertible can never trade below the price of the pure bond, which is often referred to as the bond floor. This number here is often referred to as the bond floor, since in the worst of cases the call option becomes worth zero, and at that point the convertible would just about converge in value with the pure bond. This is the case referred to as a busted convertible, an allusion, a reference to the fact that the conversion option has virtually no chance of being exercised prior to its maturity. Of course, at this point, with a busted convertible, the convertible, column L, is worth far more than intrinsic value, i.e. far more than 2 shares of common stock, which gives us a clue regarding one of the main investor attractions of convertibles, namely the ability to reap some of the benefits of a share price increase when things work out well for the company stock, while outperforming by a substantial margin, as you see here, a simple long position in common stock when things do not go as planned. Now, as the stock price rises and the call option begins to increase in value, the convertible's price, of course, also begins to rise, but initially quite slowly, as you can see, since the only impact on it is the relatively mild impact of the call option. This should not surprise you, since the call option, being so far still out of the money, would have a very low delta, as written here, and therefore reacts ever so slightly to changes in the stock price. So the value gap between the convertible and 2 shares of common stock is beginning to narrow. Gradually, the call option begins rising faster and faster, but since its delta can never exceed 1, it always lags behind the increase in value of the long stock position. So note here the 2 shares have risen by $20, whereas 2 call options, or rather call option on 2 shares, would have really risen only by 5 times 2, so about $10. And therefore the gap between the convertible and the 2 stocks, 2 shares of common stock, is narrowing fairly quickly at this point. So much so that by the time the stock reaches a price of 72, as you can see here, they appear to have pretty much converged in value. Now we got to be careful at this point. In our particular instance, the convertible appears, in column L, the convertible appears to eventually become cheaper than the long stock position. In fact, by as many as $7 when we get to the $90 spot price of the stock. Whether this happens in reality depends principally on the nature of the conversion option. If the option is an American-style option with no restrictions whatever on when it can be exercised, we would never see the long stock position trading in value above the convertible. Because if this were to happen, a risk-free arbitrage would become possible, since an arbitrageur could then purchase the convertible, exercise the option immediately, and sell the shares for an instantaneous profit. Of course, this would drive upward the price of the convertible and downward that of the common shares, until this opportunity disappeared. The principal reason you see this phenomenon in our specific case, as you may be anticipating by now, is that we are not dealing with an American option, but rather with a European one that can, by definition, only be exercised at expiration, which is 5 years away. With the call option so deep in the money at a spot price of 90 per share, the disadvantage of owning the convertible versus the shares themselves stems from the difference in their current yield. The convertible bond continues generating for the holder a current yield of 3% on 100, i.e. of $3 per annum, while the common shares would now be paying a dividend yield of 2% still, but on an investment worth $180, i.e. 2 shares worth 90 each, and therefore an aggregate of $3.6 annually. This higher cash flow yield makes the long stock position more attractive than the convertible, since in other respects the positions are essentially economically identical. Note importantly that our argument would break down if we assume the shares pay a constant dividend of $0.8 annually, i.e. if the 2% referred to the initial stock price of 40 and was always paid on that 40 at 2% exactly. Under such an assumption, the cash flow yield on the bond would always exceed that of the shares, so the bond would always trade at a higher price. But given that we're talking here of a constant 2% dividend yield, as we emphasized when we first mentioned this point, i.e. one that rises in cash flow terms with increases in the share price, it follows that at high enough share prices, the dividends come to exceed the bond's coupon in cash flow terms. Returning to our worksheet and moving over to the right of this table, as you can see us doing here, we see a graph that plots the spot price of shares on the x-axis against the value of the pure bond, shown in blue, the convertible, there's the pure bond in blue, the convertible, shown in this red or purple, whatever it is, and finally in green, the 2 shares of common stock. And there are no surprises here, but you should please recall that if the conversion option were American, we would not see the red line intersecting the green line as it does here, no matter how far to the right we go. This concludes Chapter 1.